Tax loss harvesting explained what it is and how to use it. Investment gains are taxable, and depending on your income level, the tax bill can take a meaningful bite out of your returns. Tax loss harvesting is a strategy that helps reduce your taxable investment income by using realized losses to offset realized gains. When used correctly, it can smooth out your tax burden, improve after-tax returns, and support long-term portfolio management. But it's not a free-for-all. The IRS has rules, limits, and timing requirements you need to understand before using this strategy. What comes next is a deeper, more comprehensive breakdown. What is tax loss harvesting? Tax loss harvesting means intentionally realizing or harvesting investment losses to offset realized gains. You have a gain when you sell an investment for more than you paid. You have a loss when you sell for less than your cost basis, your original purchase price. Because capital gains are taxable, using capital losses can reduce your overall tax liability. How tax loss harvesting works. Sometimes you may sell an investment at a loss to rebalance your portfolio or shift your strategy. The size of your loss depends on your cost basis. For example, you own 100 shares of company with a $100 cost basis. The price drops to $20 and you sell all shares. You receive $2,000. However, your original cost basis was $10,000. So you've realized capital loss equals $8,000. If you also realized $9,000 in gains elsewhere that year, your loss offsets most of it. You'd only owe capital gains tax on $1,000 instead of $9,000. Short-term versus long-term, why it matters. The tax impact depends on how long you held the investment. Short-term gains happen when you sell an investment you've held for a year or less. These gains are taxed as regular income, anywhere from 10% to 37% in 2025. And long-term gains happen when you sell an investment you've held more than 1 year. These gains are taxed at 0%, 15%, or 20%, depending on income and filing status. When offsetting gains, the IRS requires you to match short-term losses with short-term gains first, then long-term losses with long-term gains. Here are tax loss harvesting rules to know. Tax loss harvesting is useful, but it's governed by specific IRS rules. A tax professional or financial advisor can help you apply the strategy correctly. Rule number 1: tax loss harvesting only applies to taxable accounts. You can harvest losses only in taxable brokerage accounts. Retirement accounts such as 401k IRA, Roth IRA, don't qualify because gains and losses inside them aren't taxed the same way. Rule number 2: there is a capital loss carryover limit. When your capital losses exceed your capital gains for the year, you end up with a net capital loss, and that can help reduce your tax bill. The IRS allows you to deduct up to $3,000 of net capital losses from your ordinary income each year, or $1,500 if married filing separately. If your losses are larger than that annual limit, the remaining amount doesn't disappear. Instead, it carries forward indefinitely, allowing you to apply those unused losses to future tax years. For example, suppose you realize $8,000 in losses and $2,000 in gains. Your net capital loss is $6,000. You can deduct $3,000 this year to reduce your taxable income. The remaining $3,000 carries over and can be used in future years. This carryover feature makes tax loss harvesting valuable not just today, but potentially for many years ahead. Lastly, rule number 3 is the wash sale rule. The wash sale rule prevents investors from claiming a tax loss while immediately repurchasing the same investment. Under this rule, you cannot sell an investment at a loss and then buy the same or a substantially identical security within 30 days before or after the sale. If you do, the IRS classifies it as a wash sale, and the loss is not deductible for that tax year. Instead of reducing your tax bill, the disallowed loss is added to the cost basis of the newly purchased shares. This adjustment preserves the loss for later but delays the tax benefit. For example, on June 1st, you sell 100 shares of company at $20 per share, realizing an $8,000 loss. On June 25th, you buy back 100 shares of the same company at $10 per share. Because the repurchase happened within the 30-day window, the loss is disallowed this year. Your new cost basis becomes $10 purchase price plus $80 disallowed loss per share equal $90 per share. This higher cost basis will affect your future gains or losses when you eventually sell the shares again. Here are the final thoughts. At the end of the day, tax loss harvesting is simply a tool, one that helps you manage taxes without losing sight of your long-term plan. It's not about chasing losses or timing the market. It's about being strategic, staying disciplined, and using the tax code to your advantage. If you're thinking about trying it, make sure it fits your goals and that you're clear on the rules, especially the wash sale rule. When done right, it can quietly boost your after-tax returns year after year. Please comment below on your thoughts. I'd love to hear your perspective.